Hi, welcome to the final webinar of our web course on how to trade fundamentals called Proper Management to Protect Your Account. As always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. I ask you to read this disclaimer very carefully to understand all the risks associated with trading on margin and to seek advice from an independent financial advisor if you have any doubts. Well, we've certainly had a very full schedule on our webinars. Let's go through everything that we've covered in our course here to see exactly how much data and how much information we've really already gone through. We started out with an easy guide to understanding the global economy. Then we moved on to examining the key fundamental reports across the G20 universe that really matter, that really move currency markets. Then in webinar number 3, we delved very deeply into how to predict economic data by using other economic data to inform the possibility of how economic data could go above or below the current expectation, and basically get an edge on Wall Street and to be able to forecast what potential economic data that could move the market could help us. In webinar number 4, we spent a very pragmatic and practical session on focusing on the key tool sets from price to technicals to market color to various platforms that could help us gather the information both from a news perspective and from a trading perspective and from a chart perspective and inform our trading decisions. Then in webinars number 5 and number 6, we took a very specific currency by currency look at the euro, the pound, the dollar, the yen, the Australian dollar, the New Zealand dollar, the Canadian dollar, and the Swiss franc, the 8 currencies that make up the major set of currencies traded in the currency market, and try to understand what makes each currency unique, what are the key characteristics of each particular currency, and how by understanding those characteristics we could improve our trading ability in order to be able to construct more efficient and intelligent trades on those currencies. In webinar number 7, we spent a good amount of time discussing 4 very specific strategies on how to trade news, both before and after a news event. And now we come to the final, and in some ways, I would argue perhaps the most important webinar, and that is the money management secrets. The key idea of how to not only put these trade ideas into practice, but how to actually manage your stress capital in the process. Now, the thing that I think is very interesting and one that very few retail traders or speculators in general actually ask themselves, and is the single most important question that we can ask ourselves, is what business are we in? Now, history is littered with wrong answers. Many companies have actually never asked that question or simply answered that question in a completely inaccurate manner. So, for example, railroad companies thought they were in the train business. Shipping companies thought they were in the shipping business. And of course, all of them were grossly mistaken because the railroad companies got destroyed by the automobile companies and the shipping companies got destroyed by airplanes. None of those businesses were the ones that they were actually in. They all went nearly bankrupt until they finally figured out the correct answer to their question. The railroad companies were actually in the transportation business, and so they adjusted themselves to transporting goods rather than people, because cars now transport people, but railroads basically are very efficient at transporting goods, and their whole business model changed and they were able to survive and adjust to the new way of life. Shipping companies realized they really weren't in the shipping business, they were in the travel business. And they made the idea of travel as a luxury and a service in and of itself a tremendously powerful business. So now, ships really are basically cruise ships, effectively floating hotels that provide an incredibly pleasant and powerful experience for people. So by answering the question properly, they were able to not only stay in business, but thrive in business. Right now, for example, television networks still think that they are in a television business. And they will either realize that they are wrong or they will disappear. Because, of course, the critical thing right now is that nobody actually watches television anymore. Everybody watches entertainment on demand, of which, of course, the internet has become a huge producer of that particular service. So in many ways, television networks or television business as we know it is a dying business, and it will disappear unless they reinvent themselves as an entertainment business, which is really what they are. Now, coming back to us in our little humble corner of the world, in our corner of the Forex market, we really need to ask ourselves before we even begin this journey of trying to understand how to succeed in this business, we need to ask ourselves, what business are we in? Now, some people will tell you that we're in the money-making business. This is a very, very common misconception. Everybody thinks that, oh, you're in a trading business, you're going to manufacture money like a printing machine. Other people will tell you that we're in the market analysis business, that all we have to do is just simply be able to analyze the market, and then we will be able to succeed in this business of FX trading. Some think that we're in the finance business, that we're no different than banks or brokerage houses. Well, I'm here to tell you that all of them are 100% wrong. We're not in the money-making business, we're not in the finance business, and we're certainly not in the market analysis business. Let's take a look at what speculation really means. Speculation, as defined, is engagement in a business transaction involving considerable risk but offering a chance of large gains, especially trading in commodities, stocks, and of course in our case, Forex, in the hope of profit from changes in the market price. That actually is really, really it. Our business is the hope of profit from changes in market price. And so what that really means is that we are in the risk assumption business. Every time we make a trade, every time we decide we're going to produce an idea and lay down our capital, we're actually doing nothing but assuming risk. Of course, most retail traders don't really view it that way. Every time we're making a trade, we think it's like a lottery ticket. We think it's essentially a one-way move towards more money. All we think about is the potential for profit. And very infrequently do we appreciate the potential of risk. But in fact, we need to assume every time we make a trade that we are assuming a massive amount of risk. And the profit, in many ways, is incidental, because what we really need to manage is this risk essence that is the key thing that drives us. Let's just go deep and analyze what is it that happens to us every time we trade. Every time we trade, we assume a plethora of risks. And let's take a look at the exact kind of risks that we assume every time a trade is put on. Because I think few of us truly appreciate all of the potential things that are risky in an FX trade. The first and foremost risk is, of course, the most obvious, and that's one that I think everybody would instantaneously explain and agree. Market risk. Market risk is simply the ability of you being wrong in your market analysis. Every time we make a trade, we're essentially making a bet, a guess on the direction of the market. We believe that the market is going to go in a particular fashion, so we either get long or short. And of course, sometimes we're correct, and sometimes we're not. The market may move against us, either because we misunderstood what was happening prior and we made a bet on wrong assumptions, or because something else happens. And this something else is utterly and completely unpredictable. And that's something we call event risk. Now, this is something that I think few people can truly appreciate. The whole essence of trading, the whole reason why we have a potential for profit, is because we have a massive amount of uncertainty in front of us. We can make an assumption that things will be as they are going forward, or that things will be 180 degrees opposite as they are going now. But what we don't know is what will happen next, which is what we focus on as event risk. And event risk is, of course, the multitude of things that we've talked about here, from a central banker saying something on TV, from economic release completely and utterly surprising the market, from a geopolitical event blowing up, from an event of natural history blowing up, or from even simply a single market participant deciding at that particular moment to do something that is completely counter to the market position that we had assumed first and foremost. So this idea of event risk, which is effectively something that can either be confirmative and accretive to our position, or something that can be completely contrary and therefore negative to our position, is an unknown risk that every time we make a trade is present, and something that is utterly, I think, underappreciated by many, many retail traders. At any given time, at any given moment in the currency market, something unexpected can happen that could be 100% negative, or conversely, extraordinarily positive to your position. And there's nothing you can do about, and there's nothing you can predict. All you can do is either minimize or maximize the opportunity, but you certainly have no control over the event itself. Now, the third risk that I think is something that we do have enormous amount of control over is also something utterly and completely underappreciated by many retail traders. In the currency market, we are offered a massive, massive amount of credit. When we trade stocks, for example, in the United States, the basic fundamental credit extended to a retail trader is 100%. So 50%, basically, if you put down $50,000, you can borrow another $50,000 for a total position of $100,000. If you're a day trader and you fit the day trader model, you're given 4 times leverage. So if you put down $25,000, you may now control $100,000. In the Forex market, we're basically allowed at in certain jurisdictions as much as 200, as much as 400 leverage. So that means that if you put down $1, you're able to control $400 worth of currency. Even in highly regulated markets like, let's say, United States, where you have some control, the leverage risk is enormous. You could put $1 to control $50 worth of currency. In other markets, like, let's say, Hong Kong, you can put $1 to control $20. In Japan, you can put $1 to control $25. Now, these may seem relatively tame and relatively conservative until you actually think through what this really means. Let's take a very, very simple example of using 100-to-1 leverage. That simply means that if you have a $1,000 account, you can trade 100,000 units of currency. If you were to use all of the leverage given to you, that means if you were to simply trade at the full credit available to you, you had $1,000 in your account, and you laid down a trade with 100,000 units. Let's just, for argument's sake, you traded euro-dollar in this particular structure. You bought 100,000 euro-dollar on your $1,000 account, and the euro, and you were long, for argument's sake, you were long for this position, and the euro decided to decline by 1%. Well, that 1% decline wipes out all of your capital. 1% decline is sometimes half a day's worth of work in the currency market. This is the key thing that almost every retail trader truly underappreciates. A retail trader may think that trading at 20 times leverage or 15 times leverage, or even 10 times leverage is a modest conservative position. But at 10 times leverage, a 10% decline wipes out all of your position again. The single biggest risk control factor that is truly in the control of the trader is the ability to minimize his leverage risk. And although your leverage certainly can vary to your personal tastes, and although you certainly can trade higher leverage or lower leverage depending on what you like, the general rule of thumb is if you're trading more than 4 times leverage, so that means if you have $25,000 and every single trade you make is more than 100,000 units, you are putting your whole account at risk of ruin much quicker than you can possibly realize. It may not happen today, it may not happen tomorrow, it may not even happen for 6 or 9 months. But if you're trading at a higher leverage factor, your risk of ruin rises exponentially. Indeed, the thing that most retail traders don't understand is just like in a casino, brokers are counting on this key fact of life to make sure that they will be ahead of you, that they will take the advantage over you. Because by giving yourself enormous leverage risk, you therefore make yourself very vulnerable to adverse market moves, to margin stop outs, and to the full loss of risk capital. One of the most common strategies and one of the most common scenarios that I see all the time is traders who will have, using high leverage, will take, let's say, a $10,000 account and run it to $50,000. And then one single bad trade at a high leverage position will not only unwind all of their profits, but generally unwind all of their initial capital as well. Very much like a card player at a Las Vegas table who has a very, very hot streak and then gives all the chips back. The single biggest control factor in your risk position is how much leverage you assume. The less leverage you assume, the greater the probability that you get to keep your chips and play another day. Now, the other key risks that I think are not as widely appreciated is technology risk. Technology risk is simply the idea that everything we do in the currency market is electronic. And of course, it depends on electricity, and it depends on networks, and it depends on the ability of the internet to remain up, and it depends on the ability of your broker transaction platform to remain up. Which is why one very important factor is that if you're trading in the currency market, you almost, as a matter of good quality risk control, want to have at least 2, possibly even 3 different accounts so that you are not vulnerable to the single point of failure. You're not vulnerable to one broker going offline while you're holding a position that may not be closed, that may go against you, and that you may not be able to liquidate or sell on the other side. If, for example, let's just take a simple example of how you could hedge your risk. You have broker A and you have broker B. You're long Eurodollar in broker A, and broker A's platform goes down, and you therefore are unable to get out of your losing long Eurodollar position because you cannot execute anything against that position. If you have an account with broker B, you could then simply short Eurodollar and broker B's account, and you will therefore have created a synthetic stop for your position, meaning that as long as you have one short position, one long position, your loss overall on your total account is going to be limited. Or, as a matter of fact, your profit, if, for example, you wanted to take your profit and the other broker just simply wasn't working, will be locked in, because whatever gains in one position will be offset by the losses in the other position, and at least your risk will be defined and controlled. Now, the last risk is something that is undefined and uncontrolled, and something that should be very, very seriously appreciated in the currency market, is the counterparty risk. The counterparty risk is the assumption that is the key thing that makes this market very, very different. The currency market, unlike the stock market, for example, or the futures market, is not an exchange-based market. It is not a market where a market of many to many, where you're trading against a broad market with many different participants, and there is a central clearing house that makes sure that everybody gets paid on their profits, and everybody's losses get properly deducted. When you're trading in the currency market, you're effectively not trading with a broad market per se. You're trading directly with your broker. And so therefore, if your broker, for some unaccountable reason, is not able to either hold all your money or pay back all your money or have enough capital to pay back your profits, there is very little recourse to what you need to do. So one of the most important things you need to do when you're trading in the foreign exchange market is to appreciate that if you're going to entrust money to a broker, you really want to make sure that broker is well regulated, all of the funds are segregated, and that you have the ability to, or at least the confidence, to know that even if there is a massive financial problem within the broker, you at least will be able to get your funds back. There's almost no 100% guarantee to this particular risk. This risk is ever present, and really the only mild hedge against this risk is to be able to have accounts with several brokers, so that again you're not vulnerable to a single point of failure. But one key factor that I really recommend, one key idea that you really need to test out, is the following. If you go into an open account with a broker, any broker, whether it be a well-regulated, well-known broker or a small broker no one ever heard of, deposit money, trade for a week, and then request to have the money back. If it takes more than 5 business days or a full calendar week, this is the absolute maximum amount of time. It should not take more than 48 hours, but if it takes more than 1 business week to receive your funds back, don't do business with that broker. While this may not guarantee you against broker failure, what it will certainly give you a heads up on is broker accountability and their business process and ethics. At least with a regulated broker and a well-established one, you should be able to have free flow of funds both ways, deposits and withdrawals. Deposits are always welcome by any broker, and they'll be quickly and immediately processed. The true test of how good your broker is how well they process withdrawals. Unfortunately, this is not something that many FX traders really think about until it's either too late or the problems have really spiraled out of control. Most brokers simply assume that the withdrawal process will be seamless as the deposit process was. Never make that assumption. Always test the withdrawal process with small amount of capital before you do any additional business with any broker, including even the ones that are highly regulated. Now, there's one other risk that I think few retail traders truly appreciate that we assume, and that is the risk of clawback. Let me explain what I mean in specific detail here. If we work in a real world, in a normal business environment, generally most of us follow the following structure. We have income, which is guaranteed payments over the course of 12 months of the year, and a possible end of the year bonus. Now, basically, let's say if the company has a bad year, or if you've had a bad year and you are not given a bonus, we know with very, very strong degree of certainty that if we're on salary and if we performed work for 12 months, we will have collected let's say for $100,000 worth of income that will be deposited in our bank account save for taxes and all other incidental expenses. Even if we're a salaried individual, which typically depends on a combination of draw, which is basically deposits against your commission, and commission dollars, we know that there are at least the draw, which is usually a guaranteed draw, will provide for us, let's say, $25,000 worth of income against a potential commission of $75,000. Even if we don't do any selling, we know we will collect at least $25,000 at the end of income. What makes trading so very, very tough, especially to consider it on a job basis, is that the basic trading salary structure is quite different. First of all, it requires not your labor, it requires your capital as well. You have to invest not only your hours and time, but you have to invest your own savings. So in a typical trading salary structure, we need to invest $100,000 of our savings. The possible profits, of course, are questionable. We don't know if we're going to make profits. But we do know that possible losses at maximum could accrue to $100,000. Which means that at the end of the year, it's not that you've lost zero, or it's not that you've gained $25,000, or it's not that you've gained $100,000 at very minimum. You know that your potential possible maximum risk in this case is minus $100,000. That is a very, very different dynamic from a dynamic of a salaried structured employee. And that is something truly not fully appreciated, if not nowhere else than simply on a psychological basis, by most retail traders. So retail traders face all of the various execution risks that we talked about, but they also face a significant financial risk that a laborer, someone who trades their labor for salary, may not necessarily face. So now that we've sort of established the fact that we're in the risk business, we need to ask ourselves, what business practice should we follow? There are two industries whose models are directly relevant to trading: venture capital and insurance. Both of these models, both of these industries, are effectively in the risk business, but they use very, very different models of how they assess and pursue risk. The venture capital model basically rests on the following idea. You make many, many, many small investments, and all you need is one big win that will then completely overtake all of your massive losses and provide profits for the overall portfolio. This is the classic venture capital model. It's essentially the idea that all you need is one specific idea, and that one idea will pay for all the various losses you've taken. Now, it's a classic small risk, high reward model of trading. And this is a model that is essentially advised and shown to most traders. You risk $2 for every $1. You risk $1 for every $2 worth of profit. You risk $1 for every $3. You risk $1 for every $4. And then you don't really need to make a lot of successful trades. Just one trade out of 3 on a 4-to-1 basis would pay for all of your losses and provide a full profit at the end. This is the positive risk reward ratios of venture capital model that almost everyone teaches you. At 2-to-1, you only need to be right 40% to make money. At 3-to-1, you only need to be right 28% to make money. Now, what can be easier than that? Unfortunately, in real trading, 2-to-1 risks rarely pay off 40% of the time. Although 40% of the time seems like not a difficult barrier to break, it actually is an incredibly tough barrier to break at a 2-to-1 risk-reward ratio. The market simply doesn't print $2 bills for every dollar bill you you offer it 40% of the time. And one key problem is execution risk. One key essence, one key risk that most people underappreciate in this venture capital model is the fact that winners are rare and losers are frequent. So suppose you have 10 trades and 4 trades make $50 and six trades lose 25 pips, right? So 4 trades make 50 pips, 6 trades lose 25 pips. And overall, you are up 50 pips. This is a classic standard 2-to-1 risk reward model, something that almost every risk profile trading book will teach you as the way you should trade. But what's totally not appreciated and what's totally not explained to you is that in this particular scenario, where we're taking a sample of 10 trades, you need 4 trades to make 50 pips, and you can absorb 6 negative trades at 25 pips to make 50 trips. But what happens? What happens if we miss just one winning trade? Just one winning trade takes this strategy, which seemingly looks to be positive and looks so good on paper, in reality becomes break even. Miss 2 winning trades and you now have a losing strategy. The thing that is very difficult in real life, because you don't know which trade is the winning trade, is to be in on all the key trades and collect enough winning trades to offset the losing trades, especially when the winning trades are rare, but the losing trades are many. If you think about it, basically, when you have lots and lots of losing trades as a matter of distribution, as a matter of function of the strategy, your probability of hitting those losing trades is going to be quite large, whereas your probability of hitting those winning trades may be small. And in real life, the probability always increases for the losing trades and diminishes for the winning trades. So having a venture capital model is not necessarily the best possible solution to how we can manage our risk. In real life, of course, venture capital payouts are more like 100 to 1. In other words, in true venture capital funds, they will fund 100 different companies, or let's say 100 different companies. 99 of them they expect to fully fail, and one of them will return them more than 100 to 1 investment. Let's say 200 to 1. They invest $1 million into 100 companies. 99 of them go bankrupt, and one of them makes that $1 million worth $200 million. It's the Twitter, it's the Facebook, it's the Google of their portfolio, and that pays for all of their potential losses. Now, you can ask yourself, is it possible to take 100 trades risking 10 pips to make 1,000 pips? Yes, it's possible, and perhaps you can take 99 trades where you're going to be stopped out for 10 pips, and then in the 100 trades you're going to make 1,000 pips. But likely, not really, and perhaps it's really not the best way for us to trade. It may still be a valid model for trading, but I think the other model, the insurance model, may be a more interesting model for us to examine as retail traders. Now, on the face of it, the insurance model seems absolutely crazy, especially when it comes to something like term life insurance. In a term life insurance structure, you can pay $1,000, and if you die, the insurance company will pay you out $1 million. And the key question that almost everybody asks is, how can insurance companies make money like that? But the answer is that insurance companies, especially in term life insurance, are the single most profitable business activities around. You can see this in almost every single press release where insurance companies just make money hand over fist. Insurance is the ultimate high probability, high risk trade. And insurance companies basically spend all of their time figuring out how they can maximize their probability and minimize their risk. So what can we learn from the insurance business that can help us with our trading business? Here's what insurance companies do from their risk model perspective that I think could be very valuable to us as traders. First and foremost, insurance companies always capitate their risk. What that means is, even if you were to buy a term life insurance policy for $1,000, the insurance company's risk is never unlimited. They're never willing to say, oh, we'll insure you for unlimited amount of money. They're always going to tell you that they will maximize their payout to a particular number. Let's just, for argument's sake, it's $1 million. That means the insurance company knows ahead of time exactly how much money it's going to lose on the transaction if it is wrong. This is the same idea as using a stop loss. The point that insurance companies do, and a point that all of us can absolutely adopt from their model, is that they very much know ahead of time their total and cumulative risk on any given transaction. Now, of course, given the fact that I have just talked about all the execution risks and all of the unknown factors, using a stop loss does not guarantee us that we will know ahead of time exactly how much money we can lose. But at very minimum, we can at least protect and have a general idea of how much money we can lose. Certainly, in real life, stops get missed, prices fall through, and we may lose sometimes twice as much, or maybe 3 times as much. But we certainly will not lose an unknown amount. And generally, it's very rare that we will lose more than 2 times our stop, even in the worst market conditions, unless there's some extraordinary event that happens. Which brings me to my second point. Insurance companies rely on the idea of large numbers. Here's the key thing that insurance companies do that is very, very valuable to us as retail traders. In the situation where they sell an insurance policy to someone for $1,000 and they now have to pay out $1 million, they're fully prepared to do that because they are going to sell not 1, not 2, not 3, but literally 1 million insurance policies, or let's just say, for argument's sake, 100,000 insurance policies with $1 million face value against it. And they know that if they sell 100,000 insurance policies, maybe 6 out of 100,000, maybe 60 out of 100,000, maybe even 100 out of 100,000, whatever the numbers are. And believe me, the numbers are enormous. The numbers, I believe that for every $60 million worth of insurance premiums they collect, they only pay out $1 million worth of life insurance because they know their odds very well. But the point being is, they know that whatever losses they suffer in the grander scheme of things really mean very little. They rely on the law of large numbers. And this is absolutely crucial. What insurance companies do is, just like venture capital companies, they make a lot of trades, but they don't make 100 trades. They make thousands of trades. They make a very, very broad amount of trades. The broader amount of trades you make, the less any single trade is going to affect you, assuming you properly size it up. And we'll talk about what it means to properly size up your trade. Certainly, if an insurance company, let's just go back to the insurance company model. As I talked the idea that they know they're going to write 100,000 policies, and they know that at any given time the maximum amount of policy value they're going to write it on is going to be $1 million. That'll be their stop loss, right? Now, if we were foolish as retail traders, we would make our stop loss in insurance relative terms $1 billion. So if we wrote a very, very large stop loss, then even 1 out of 100,000 would certainly be very, very bad. The issue here is twofold, and it's very nuanced, and you need to understand it. It's the idea of making large amount of trades and risking very, very little on each individual trade relative to that large amount of trades. That's the key thing of the law of large numbers. And that is what we need to learn from insurance companies. Now, the other thing that insurance companies do that is extraordinarily important, the single most important thing for us as traders, is they underwrite their risk properly. So what I mean by that is, I'm going to apply for a life insurance policy. And I am a fat, highly overweight individual who drinks 2 bottles of vodka a day, smokes 2 packs of cigarettes, drives a motorcycle, and occasionally